Today we have the final numbers for 2022, the December existing home sales report. Let me sum it up with this quote from Lawrence Yun, NAR's chief economist. December was another difficult month for buyers who continue to face limited inventory and high mortgage rates. However, expect sales to pick up again soon since mortgage rates have markedly declined after peaking late last year. Before I go on, let me just say that this quote is a very positive quote. Because as I shoot this video, I'm seeing more and more people say that we might have hit the bottom. I'll get into that later at the end of this video, but you should also check my past video on that. Let's get on with the latest report. Inventory at the end of December was 970,000 units. This is only existing home sales and does not include new construction. This is down by 13.4% from November, but up 10.2% from 1 year ago. So when we compare the number of inventory month to month, we are going up. But year-to-year comparison, we are down 10.2%. What's happening is that homes are taking longer to sell. This is why you see month-over-month inventory comparison going up, and yet the year-over-year is going down. And speaking of homes taking longer to sell, unsold inventory is at 2.9 months supply at the current sales pace. That's down from 3.3 months in November, but up from 1.7 months in December of 2021. This means that if no new inventory comes on the market, it will take 2.9 months to sell everything at the current sales pace. For context, before all this craziness happened in the market, 6 months worth of inventory was considered healthy for a balanced market. So when we look at the numbers, we are down from November of just over 3 months to a little under 3 months, which means inventory is still not enough, but almost double when compared to December of 2021. So what do we make of these numbers? Well, it depends whether you are a buyer or a seller. If you're a buyer, this is somewhat good news. It's not totally good news. And this is what my challenge is with some of my home buyers. While they have a little bit of negotiating power, you can't take forever to make a decision or you lose out on the property that you might be interested in. One case I want to point out that I want to share is one of my listings in downtown San Francisco. For 60 days, hardly any activity. And then 2.5 months in, showings every day or every other day, and then several showings on the weekend. After that, we get an offer that was very close to our asking price. The point that I'm trying to hammer here is that because no other unit was getting listed for sale in that building, so all these buyers that were waiting to see, for one, for us to drop our price, and two, for new inventory to come up. They waited for nothing. We didn't drop our price. No new inventory came on the market. So this forced the hand of the buyers that were interested in that building. And the one that acted first got into contract with us. For sellers, I guess you can look at this as a bad thing because the reality is that gone are the days that you put a sign on the front yard and by the next day you have 20 showings and 15 offers. Yes, you missed the top of the market. You now have to negotiate in price, terms, and condition. However, like I said, just like with buyers, it's not at the extreme, unless of course you vastly overpriced your property. Here's another example I want to share with you before I continue on with the report. I had one seller that the sale fell through. The buyer backed out. Within a week, we got another offer that was the same as the first one. And after we got that offer, 2 more buyers expressed interest in the property. There is activity out there. It's just slower and lesser. Moving on to price. The median existing home price for December was $366,900, an increase of 2.3% from December 2021. This marks 130 consecutive months of year-over-year increase, the longest running on record. I gotta tell you, back in October, I was calling for this to start going down already, and it's not happening. For all the negativity that you hear about the real estate market in the news, we continue to go up in price. Again, just to hammer the point in that there are still buyers out there. Here's another quote from Lawrence Yun. Home prices nationwide are still positive, though mildly. Markets in roughly half the country are likely to offer potential buyers discounted prices compared to last year. Unquote. And moving forward, I think we continue to see this strength in home prices, but always remember every market is different. Case in point again, here in the Bay Area, the median home price for all 9 Bay Area counties last month were down when compared to December of 2021. But when we look at the year as a whole, home prices still managed to go up. Even in San Francisco, where it seems like everything is going down. I talked about inventory sitting on the market longer earlier. And properties typically remain on the market for 26 days in December, up from 24 days in November and 19 days in December of 2021. But even with these days on the market climbing, still 50% of homes sold in December 2022 were on the market for less than a month. That is still fast. It's not 19 days fast, but still very good. Let's look at the breakdown of the types of buyers that we had. All cash sales accounted for 28% of transactions in December, up from 26% in November and 23% in December of 2021. All I can say is, wow, even in my own experience lately, whether I'm representing the seller or the buyer, I'm still encountering several cash buyers. The reality is that these cash buyers are not affected by these mortgage rate increases. And I can see most of these cash buyers taking advantage of the lesser competition and to some extent, softer prices. Individual investors or second home buyers who make up many cash sales purchased 16% of homes in December, up from 14% in November, but down from 17% in December of 2021. This is still within the average and hasn't changed for a couple of months. Distressed sales like short sales and foreclosures represented 1% of sales in December, virtually unchanged from last month and from 1 year ago. This number actually hasn't changed in over 2 years now. It might have gone up a bit because of the end of the moratorium on foreclosures, but not enough that it's affecting prices. And don't count on it being like 2008 all over again. Interest rates have been either stable or slightly going down. According to Freddie Mac, the 30-year fixed rate mortgage averaged 6.15% as of January 19. That's down from 6.33% from last week, but up from 3.56% from 1 year ago. So yes, we're still way higher from what they were from 1 year ago, but we are starting to see some semblance of stability in the market. And moving forward, unless the Feds go crazy on upping the interest rate, the second half of this year, we could start to see interest rates go down below 6%. I think when that happens, it's like someone flips a switch again as buyers start coming out of the woodwork. In terms of breakdown between detached and attached sales, here's how the numbers look like. Single-family home sales declined to 1.1% from November to December and a huge 33.5% from the previous year. The median existing single-family home price was $372,700 in December, up 2% from December of 2021. Existing condos and co-ops were down 4.5% from November to December and down 38.2% from 1 year ago. The median existing condo price was up 3.3% from December. As you can see, on both detached and attached sales, it follows the pattern. Severely down on the number of transactions, but home prices just keeps going up. Okay, let's go to the regional breakdown before I end with my final thoughts. Existing home sales in the Northeast down by 1.9% from November to December, but down almost 29% from December of 2021. The median price in the Northeast was $391,400, an increase of 1.6% from the prior year. Existing home sales in the Midwest down 1% from the previous month in December and falling 30.3% from 1 year ago. The median price in the Midwest was $262,000, up 2.9% from December of 2021. In the South, existing home sales down 2.2% in December from November and down a 33.1% from the previous year. The median price in the South was $337,900, an increase of 3.5% from last year. Surprisingly, here in the West, existing home sales were unchanged from November, but down a huge 43.4% from 1 year ago. The median price in the West was $557,900, an increase of $200 or less than 0.1% for December 2021. I am starting to believe that we have or maybe near the bottom in terms of transaction numbers. We are at a point where the buyers on the sidelines just can't wait or don't want to wait any longer for things to get better. Now, I'm talking about transactions number here, not home prices. That's different. When we look at home prices, it just continues to go up. I guess when it comes to home prices, it really depends if you are a seller. The bottom line is that we are not seeing, or no one is forecasting, home prices to crash. At least the people that I follow. Yes, there is weakness and there will be continued weakness, but definitely not a crash. Particularly because right now, consumer sentiment has improved as Americans are finding relief from inflation and feeling optimistic. The latest reading from the University of Michigan shows that the sentiment is the highest in the past 12 months and consumers' assessment of their personal finances has surged to its highest level in 8 months. However, their spending behavior remains cautious despite the improvement in sentiment. Bottom line here is that we are not seeing weakness in price while the number of transactions plummet. I actually think it's a little bit of a return to normal. However, I think these numbers are going to get pulled down by high-priced areas like here in the West. We're most likely going to see a lot more pressure on prices here, particularly here in California, where we're seeing a lot of layoffs from tech companies. These layoffs are vastly different from the layoffs during the pandemic. These are high-paying jobs. There have been a number of tech layoffs in the Bay Area in recent months, with some companies citing the ongoing COVID-19 pandemic and economic downturn as reasons for the job cuts. These layoffs are already impacting the real estate market in the Bay Area, as fewer people employed in the tech industry may lead to a decrease in the number of demand for housing. Whether purchase or rentals, this could result in a slowdown in home sales, a decrease in home prices, and an increase in rental vacancies, which would pull our national average down. You see it in San Francisco already. Hey, that's the latest and greatest. Thanks for watching.